Hello, and welcome to Smart Mortgage Insights. I'm Mandy LaRose.
And I'm Conor Levinka. Today we're going to talk a little bit more about the nitty-gritty of what and how we do what we do. And specifically, we want to talk about lending's relationship with the CFPB, the Consumer Financial Protection Board.
Whew, riveting.
Gosh, our acronyms just limitless.
Right? I tell you what. So, today we're going to talk about the CFPB. What do? They regulate us, and they protect you.
Pretty much.
Nutshell. I mean,
pretty much. They're there to make sure that you are protected.
Absolutely. They're there for your consumer protection. So if you have, not just mortgage lending, really, with financial, with banks, other institutions, car loans, credit cards, things like that, you're having issues. That basically you can complain to the CFPB, and they will then do course of action at that point is their plan anyways. And we'll tell you why they came in, why were they born. So they really, the reason that they came to be is from the the financial crash of 2007 and 8. And if you're not aware of exactly what that is or was, I am, because I lived through it doing mortgage lending. It's basically what had happened during the mortgage crash. And we did not see that too much here in Alaska, mainly because in Alaska, we had our own crash in the 80s. And so a lot of lenders were kind of a little hesitant to come and do lending here, even in the early 2000s. So we didn't see a lot of what had happened in the States. But basically what it was is I'm going to call it this, it was the Wild Wild West is really what it was. There were loan programs, all sorts of loan programs out there that were not regulated. You might have heard of things like income stated loans, asset stated loans.
Negative amortization.
Made up loans, make up your income, make up your assets, you get a mortgage. Really, if you were breathing, it seemed like you got a loan. It just was one of those things during that time, during the 4, 5, 6, and 7, that if you were alive, you deserved a mortgage. And so there was going to be a way for you to get one. A lot of those mortgages were first and seconds. Maybe a first was at an 80%. The second was the other 20%. So they were 100% financing. Values were going through the roof. People were building all over the place. But a lot of those interest rates were adjustable rate mortgages. And so what happened is when those rates started to adjust, and those borrowers made up income was not really their income, and they no longer could afford that mortgage, then problems started to happen. And that's where we started to see the foreclosures come into place, and therefore the market crashing. And so the CFPB was born, the Dodd-Frank, and basically they came about and said in 2010, we're going to start regulating you. And so that's really where it originated. And that's why it's here now.
Yeah, and it's really all these different mortgage programs, they have their place. The biggest thing about this is transparency. Any term out there, it's not necessarily a bad or negative term, provided that you know about it. If you know what you're signing and you want to get a negative amortization, interest-only loan with a massive balloon payment that's going to have a teaser rate that's extremely low, and your payment could triple or quadruple in the next 12 months, that's okay. But what we really did in our world is it's now separated into what's called a qualified mortgage and a non-qualified mortgage. And so when you get a qualified mortgage, you're not going to have these scary type of terms. These scary type of terms, they still exist in the market. There's still a market for them, but that is the non-qualified mortgage world.
Absolutely. These mortgages are very regulated. Honestly, the loans that we do nowadays are some of the best performing loans that have ever been done in the time of mortgage lending. And if you've gotten a loan in the last 10 years, you understand why. Mm-hmm. We like to get a lot of paperwork from you. And it's really what it comes down to is your ability to pay. And that's what we have to make sure is that you can afford whatever mortgage is that you are getting into. But what the CFPB is also going to do too is they're going to regulate what we're doing as far as making sure, they're not going to regulate what we're necessarily doing, but that is a place where you can go to complain about what other lenders are doing and or not doing based on fees, rates, and things like that. As mortgage lenders, we have to be very transparent when it comes to giving fees, rates, and things like that. And so we are regulated to make sure that when we quote a rate, when we quote certain fees, that you know what those are going to be. Like Conor was saying before, you're not going to get to closing and be like, oh wait, my loan's be an adjustable rate mortgage. There's no world that we live in now when you're doing mortgage lending that you just find out when you get to closing. You are going to know what type of loan you're getting, what the terms are, what the rate is, and what it's going to do after that.
And you as a consumer, you can know and feel safe that you're always going to be protected, because this is not something that's optional for us. This is not something that we say, oh, we're gonna abide by these rules on Mondays and Tuesdays, but Wednesdays and Thursdays, that's another thing. No, we live and breathe by these rules. And so there are certain things that we have to do that we'll actually talk about in our next episode to stay in compliance with the CFPB and all of their rules. So just know that you're protected, and we're watching out for you as well.
Absolutely. Yes. We're watching out for you. They're watching out for us. We're all being watched.
Everyone is being watched.
Yes, we are.
So we hope that we shed a little bit of light on that for you, on our process on how we do what we do. And we thank you for joining us, and we'll see you next time. This podcast is sponsored by Residential Mortgage, LLC, NMLS numbers 167729, 196 576, and 1820404. Equal housing lender.